So, good evening and a very warm welcome to all the participants for this very special webinar session today. It is special for a reason because for the first time we had the honor of hosting four distinguished professionals from the industry for an engaging panel discussion on a highly significant topic, financial independence and retire early. This topic is literally every person's dream here, including me. So, without further ado, let me introduce our esteemed guests. It is truly my privilege to present them to you. So, first we have Mr. Arun Kumar. Mr. Arun Kumar is the Vice President and Head of Research at Funds India, one of India's largest digital wealth management firms with a robust 15-year track record and over rupees 14,000 crore in asset under management. He's the author of the book, The 80-20 Money Makeover, a simple yet powerful system to transform your financial future, published by HarperCollins. With over 13 years of experience in the wealth management industry, Mr. Arun has worked with renowned firms like 361 Wealth Management Limited and Wealth Advisors India Private Limited before joining Funds India. He's also a prolific personal finance blogger at 8020investor.com and the Funds India blog, and regularly contributes to leading business publications such as Live Mint, Economic Times, Business Standards, Forbes, Financial Express, Outlook Money, and Money Control. Next, we have with us Mr. Ravi. Mr. Ravi Sarangi is the founder of Samastiti and a SEBI registered investor advisor. Previously, he has led the fundraising and product design verticals at Northern Arc Investments, and he has also worked in institutional equities research at IIFL Capital and JP Morgan and with HSBC's Business Intelligence team. He is a member of the Professional Learning Committee at the CFA Society India and a technical consultant at Dwara Research, an organization promoting financial inclusion in India. Additionally, Mr. Ravi consulted with the Social Impact Investment Team at the National United Nations Development Program. A regular writer at business publications such as Economic Times, Mint, Business Line, and Business Today, Mr. Ravi holds a master's degree in economics from the Madras School of Economics and is a CFA chartered holder. Next, we have with us Mr. Neil. Mr. Neil Burate is a personal finance editor at Mint, leading the personal finance team. He holds a graduate degree in law and economics and a postgraduate diploma in investment from the University of Birmingham, UK. He has also passed the CFA Level 1 examination. He began his career in personal finance writing in 2016 at Value Research, a mutual fund research portal, and later joined Mint in 2019 as a mutual fund reporter, advancing to deputy editor in 2022. Neil is also the co-author of the book, The Big Bull of Dalal Street. Last and one of our frequent and favorite speakers, Mr. Aditya Kondawar. He is a partner and vice president at Complete Circle Capital, managing assets worth rupees 4,000 crore. He is a national best-selling author and finance educator with a substantial following of over 1.5 lakh on Twitter and LinkedIn. Mr. Aditya is dedicated to simplifying finance with his audience and helping new investors create wealth through the financial market. I welcome you all, and the floor is now yours to take over. I would request to Mr. Arun to start with the session.
Sure. Thank you so much, Raji, for the generous introduction. So I'll just move on and start as soon as possible. So to just start the context, I'm not going to talk about why you need financial independence and all that, because it's a given that all of us understand that it's a great place to be. So I'll just boil down into the real stuff, which is that every time when somebody talks about a financial independence, right, the initial thought is like, what is the number, right? And obviously there are several different variations of what is the multiplier of your annual income. So let's say if I require 10 lakhs a year, there are some people who might say if you get 20 times that, you should be fine. There are some people who would say 25, 30, but all said and done, say probably I would stick to a number roughly at 25 to 30 times. But most important than this is the fact that this number looks large, whether you're putting 20x or 30x or 25x. Net this number looks very, very large. So every time somebody uh, uh, tells, or if there is a webinar on financial independence, the initial thought is it is great if somebody gets there, but probably it's not for me because the number is very, very, very large. So which is why I'm going to break down this number and see if there is a way in which we can make this a lot more digestible, and also evaluate if we probably can we make it a lot more possible, right? So the first insight is a very simple thing. Just one second. Yeah. So the first is a very, very simple insight that the first 1 crore is probably the hardest. And I'll there is no major secret of why this 1 crore is hard. A lot of us kind of get to hear this fact that rich gets richer, right? Net, if you really look at it, it just boils down to math. So let's say, for hypothetically, for an example, let's say you are somehow able to work really hard, save well, invest well, and you get to that 1 crore number, right? Now it might probably take you 10 years, 15 years, depending on how much you are able to save and invest. But let's say you are at 1 crore, and after that, the next 1 crore mathematically requires you 100% returns. But then from 2 crores to 3 crore, it's you don't need 100% return, you only need 50%. Then again, from 3 to 4 crores, you only need 33% returns to hit the next 1 crore. So similarly, you can see that by the time probably you are at 9, 10 crores, you only need 10, 11%, right? So effectively, the simple point is that initially, while it's very, very hard to do 1 crore, after that, the incremental 1 crore becomes a lot easier because the returns required is much, much lesser for the same 1 crore. And then if you put that in terms of, let's say you are able to get 12% returns, how many years would it take? Probably from 1 to 2 crores, if it took you around 6 years, the fifth to sixth crore will probably take you only around 1.5 years. So the broad starting point is that while the end amount of, say, whatever, 5 crores, 10 crores, or whichever is the number that you're going after might look very large, but if you start building a reasonable base, so let's assume 1 crore is that base, after that life becomes a lot easier. So the first takeaway that I want all of you to remember is that the first 1 crore is the hardest, but once you reach there, then it incrementally becomes easier. And a very similar thing is also, there's a famous quote by Charlie Munger saying, I think it's first million or something, where it's the toughest thing to happen, and then after that it becomes easy. The reason is very simple. It's pure math. So there's no conspiracy that rich is getting richer. It's just that it's 100% pure math. So with this, the next question is that even 1 crore is very, very hard to have. So how do we start thinking about 1 crore? So there's a very simple idea called 732. This is otherwise called as power of compounding and all that. But for a normal layman, how do I break this 1 crore, and then how do I start thinking through it? So the math goes like this. If you can invest, say, 30,000 every month. Now, right now, don't debate it saying that I don't have 30,000. How do I get 12%? How do I hold for 10 years and all? Let's stick to the math. If you're able to do 30,000 a year, and then at 12%, sorry, 30,000 a month, and you do it consistently for, say, around whatever, 7, 10, 20 years at 12% returns, the first 50 lakhs will probably take you somewhere close to 7 years, right? But here comes the fun fact that the next 50 lakhs will only take you close to 3 years. Then after that, the incremental 50 lakhs will only take you close to 2 years. And then again, the next 50 lakhs will only take you 1.5 years. And then 1 year, 3 months, and then incrementally it just takes you 1 year. So probably after your 15th year, you're almost making the same 50 lakhs, which took you 7 years in almost every year. And the moment you cross 20 years, you're almost making double of it. So you're almost making, you're incrementing your portfolio almost by 1 crore every year, right? So the broad logic here is very simple, like what we saw in the previous slide, that once your base becomes big, it's not just your contribution, but your portfolio's returns will also start incrementally contributing a very large amount. So the key idea is that if you can start with a particular amount and you are able to increase that particular amount every year by 10%. So in this case, I forgot to mention that this particular 30,000 will also have to be incremented by 10% every year, because again, your salaries will also keep growing every year. So the broad math is very simple, that now obviously you can do 10,000, or somebody might be at higher at 50,000, 1 lakh. There are different sets of it, but this is completely under your control. So the larger is your monthly investment that you can do, and if you can increase it every year, and if you are able to get say anywhere 12% or more than that, then this journey can be a lot faster or slower depending on all these three numbers, how do they pan out. So the key idea is that uh, the amount might look very small incrementally, and the first 7-10 years might look very hard, but after that incrementally it becomes easier. So the key is for you, how do you plan it? Here is a simple slide which basically shows at 10,000 how long does it take for you to hit that 1 crore, assuming that you are able to increase this SIP amount every year by 10%. So at different levels, so whatever is your savings, you can roughly get a sense of when do you hit your 1 crore, and then you can see how the second crore comes a lot faster, while the first crore might take you a very long time. The second crore is always faster. Similarly, the third becomes far more faster. So this is the broad logic. So overall, putting it together, the first 1 crore is the hardest, and to get to the first 1 crore, you need to start with some savings, which you are able to invest in any asset which can probably give you more than 12%. And can you do it consistently over a long 10-20 year kind of a time frame? This is the starting point. So overall, if you really think about it, there are just three levers to it, right? Now, first is the savings lever. So a lot of us don't focus on this and directly move to the return lever. But I think in the early stage of your career, the key thing to focus on is, let's say, if you're spending 10 hours on your weekends trying to figure out which is a stock that will give you better returns. If you can put the same 10 hours on in your profession, so let's say you're a doctor or you're a photographer, and you learn better skills, then the upside that you get from increasing your salary is far higher, because that permanently stays, and hence you are able to also save better. So I think there are two levers in terms of savings. One is, can you increase your skills and improve your salaries, right? If you focus more on that and make sure that you are growing your salary by as high as possible, instead of trying to do 15-20% returns on your portfolio, if you can do 15-20-25% returns on your salary, nothing like it, and this will automatically come once you have better skills, right? The second part is, what percentage of your salary are you able to save? Roughly the fire movement goes extreme, where it doesn't focus on the trying to increase the salary part, but goes to an extreme and says save say 60%, 70% of your salary. I am probably not in this camp. I would say 30%, 40% is a lot more balanced. But if you go 70% is still very hard. There are people who do it, but they have very stingy lifestyles, and it's very hard. At least I am not able to visualize that. So my sense would be, savings has two components. So don't forget the income component, because the upside that you can get on income is unlimited, and the moment you get it, it also continues for a long period of time. So my sense is, for the first 10-15 years, make sure that you're not focusing on returns compromising your income and your savings rate. The second part is returns. So there are two levers. How much is your equity exposure? My sense is, have a very high equity exposure, at least at the early part of your career, because all said and done, the incremental savings that you do as a percentage of your portfolio will be very large. Because let's say if I have a portfolio of 10 lakhs, and if I'm saving, say, 3 lakhs every year, right? That in itself is 30% growth. Now, on top of it, so if you really look at it in the initial years in your portfolio's growth, your contribution actually is a far higher number compared to your portfolio contribution. And at some level, as the portfolio grows, this number kind of starts to move more towards the portfolio. But till that stage, my sense is, don't overdo this whole which fund is better, which stock is better. Just focus on high equity exposure and keep your portfolio construction really simple. Maybe a simple Nifty 50, or a Nifty large cap, large mid cap 250, which is a split of large cap and mid cap, should be more than enough, at least till you go for, say, 10 lakhs, 20 lakhs, 50 lakhs. And post that, maybe you can try doing active funds, try doing asset allocation strategies. But my sense is, initially, keep it really simple, because the real lever for the first whatever 20 lakhs, 50 lakhs is going to be really your savings. While it is a very hard thing to hear, but that's the reality of it. And the third final part is the time. If you can start early, nothing like it. Because if you just put the math out, if you want to save 10 crores by say 60 years, right? Somebody starting at 25, I have a slide here. Somebody starting at 25, right? They will roughly need to do 15,000 SIP. Whereas if you start by 30, for the same 10 crore, you will have to do a 30,000 SIP. And similarly, if you delay it by 5 years more, you almost have to do a 50,000 SIP. So you can see that the earlier you start, the better it is. The logic again is very simple. At 20 years, every 1 rupee that you put is almost doing 100x by the time you're 60. At 25, the same 1 rupee is only up 50x. So which means that if you can put 1,000 bucks at 20, then it's almost equivalent to a lakh when you're at 60. But the same 1,000 bucks that you put at 25 is only 50,000, roughly 50,000 by the time you're 60. So though it is amounts are small, if you can do it early, the multiplier effect is very large. So simply start early. The last part is the hardest part, is to do this consistently over a 10, 15, 20-year cycle. And so my sense is these are the three levers, and obviously the other three friends of mine will focus on the other three and tell you on how what are the nuances to it. But net, it's these three and how good you are at optimizing for all these three and balancing it out. And the most important thing is once you figure out the plan, to do it consistently over a 10, 15-year cycle. So yeah, that's broadly my what I wanted to share for the start. Ravi, you can take it over from me. I'll just stop my sharing.
Are you able to hear me now?
Yes, sir. We can hear you very.
Perfect. Okay. Sorry,
Yes.
apologies for that. So today we're just going to talk about safe withdrawal rates for retirement planning. Thanks a lot, Arun, for setting the context. So designing a good retirement plan can be very, very tricky. So as financial planners at my firm, we do financial planning, and it's very easy for us to see that when we talk about one-time financial goals, like buying a house or buying a car, it's relatively easier to plan for those goals, because at the end of the day, you have to accumulate a sum of money and use it in one shot for that goal. So mathematically, it's a much easier goal to tackle. Of course, behaviorally, even that can be a challenge. Retirement is extremely complicated, because somebody can be in retirement for 30 to 40 years, and if somebody is looking for a very early retirement, that individual could spend about 50 years in retirement. Now, how do we as planners project asset returns, equity returns, debt returns over half a century? What inflation numbers do we use? How do we really compute what is an adequate retirement corpus that you should have? And how do we know what is a sustainable withdrawal that you can do, which will last you over 30, 40, or 50 odd years? When you look at the retirement problem in this context, it immediately becomes very clear that this is not an easy problem to tackle. So let's take a look at how typically retirement, withdrawals is done, or the computation for that is done.
Ravi,
Calculate.
Ravi, do you want to speak up a little? People are saying your voice is a little low.
Sure. Okay. So is this better?
Yes, yes. We
Yes.
can
Okay.
hear you well.
So for an individual, we arrive first at what is the retirement corpus. We assume a rate of return. We assume a rate of inflation. We estimate for how many years retirement income will be needed. And then we calculate the monthly retirement income, right? So let's take a simple example. So let's say somebody has 100 lakhs of retirement corpus. So that's 1 crore. The portfolio is earning 7.8%. Let's say it's a mix of debt and equity at earn 7.8%. And let's say the individual is going to spend 30 years in retirement. So a very simple computation in Excel using the PMT function, you will get that the yearly retirement income is 8.7 lakhs. Just a small note here, you see that the portfolio is earning 7.8% on 100 lakhs. So that's 7.8 lakhs a year. But you can actually withdraw 8.7 lakhs. And that's because we are assuming that the individual is not only going to consume the income from the retirement portfolio, but is also going to consume the principal. So the retirement corpus can go to zero at the end of the individual's life expectancy. Now, if you look at this computation, a small problem here is that nobody wants 8.7 lakhs each year. They would ideally want this yearly retirement income to increase every year. So what we do is we adjust the blended rate of return 7.8% with inflation. So that adjustment gives us 1.7% inflation adjusted return. And then when you use this number, you arrive at a yearly retirement income of 4.2 lakhs. So on about 100 lakhs of retirement corpus, you will get a yearly retirement income of 4.2 lakhs, which you can increase by inflation, which is 6% each year. So I think when we look at retirement planning, I think this is the level of sophistication that we have reached at in terms of planning. But the previous calculations, they are based on averages, and averages can be quite misleading. So my endeavor would be to just show you over the next couple of slides why these kind of computations can be quite problematic, and a lot of people use these kind of computations to judge their retirement readiness. The problem with these kind of computations is that they hide volatility. If you looked at the previous examples, you see we are assuming a fixed rate of return that the portfolio is going to earn each year, right? Uh, these computations assume that the portfolio is going to earn 7.8% return year after year after year. We know that that's not true. That's not true even for the 100% fixed deposit portfolio. Forget about a portfolio which will have a mix of debt, and equity. So when we use averages in our retirement computation, we are hiding volatility. We are also hiding the sequence in which the return in a retirement portfolio is earned, and we'll take a look at that, subsequently. I think ideas are best explained through stories. So I have concocted a story. This is an entirely fictional story. Apologies to any real life Shalini and Mayas there. But the data in this story is, actual data. So let's talk about this story. It has two players, Shalini and Maya. Shalini, she's 60 in the year 1996. She's about to retire. She has had a very fulfilling career. At In 1996, at the age of 60, she has accumulated a savings of 1 crore, which is terrific, given that we're talking about the year 1996. She calls her advisor Maya and asks her to check how much she can withdraw, for her retirement corpus. Now, this is Maya's analysis. Shalini's current age is 60 years. She assumes a life expectancy of 90. She assumes equity will give 11% return, which is conservative because we are talking about the year 1996. And if you look at the previous 10 or 20 odd years of equity returns from 1996, equity gave much better returns. She assumes a debt return of only 7%, which is again very, very conservative because inflation used to be very high. If you look at the fixed deposit rates in 1980s and 1990s, it used to be quite high. We have an asset allocation assumption that she made, equity 70, debt 30. And she tells Shalini that you can consume a monthly pension of 50,000, which you can increase by 6% each year. So this was the analysis. Now let's see how that analysis panned out. So here, if you look at the x-axis, it starts from 1996 because that's when Shalini retired, and on the y-axis is the retirement corpus. So this is what was expected. This is what the math suggested. Shalini starts with 1 crore retirement portfolio. Initially, the retirement portfolio will increase in value. That's because the retirement portfolio is quite large. The initial withdrawals are quite small, and the income that the retirement portfolio is earning is quite substantial. But there will come a point of inflection where, because of inflation, her expenditure will start outstripping the income from the retirement corpus. That's the point where this curve starts going down, which means from that point onwards, Shalini actually starts consuming not only the principal income component of the retirement corpus, but also the principal component. However, based on Maya's calculation, the retirement corpus will not go to zero before 2026, which is when Shalini will turn 90. Now, this blue line, that is the actual data. So I have taken 1 crore retirement portfolio of Shalini, looked at actual debt and equity returns, and that's how the line looks like. You can see that Shalini's retirement corpus, it exhausts 10 years before expectation, right? And that's a massive blow, right? You can see how during the 1999-2000 crash, the portfolio value dips. There is a substantial gap between the expected value and the real value. But the portfolio recovers quite well during the 2003 to 2007 bull market. And actually, the portfolio does achieve the expected value by 2008. But then there's a crash again. From that crash, the portfolio doesn't recover at all. This is a classic example of how volatility can wreak havoc in your retirement planning if you have not accounted for that volatility while computing, your retirement plan. So what went wrong? So Maya actually got her return projections absolutely right. So he had projected equity returns of 11%. Between 1996 and 2016, the actual equity return was indeed 11%. So it was not that the portfolio exhausted before expectation because Maya was very aggressive in her, return assumptions. She had also assumed debt returns of 7%. The actual debt return between 1996 and 2016 was 9.5%. So the culprit was that we did not make a provision for volatility in our portfolio. We completely ignored the sequence of return risk, which is very, very important when we are designing, retirement plans. If you want to look at more such simulations, we have a retirement calculator on our website. You can go there and you can download and you can play with multiple scenarios to see how volatility can be such a dangerous thing in a retirement plan. So we need a new approach. I think we need a much better approach for retirement planning, and that one of the possible ways, one of the possible better methodology is by using the safe withdrawal rate. It's the rate, safe withdrawal rate is that rate of withdrawal which you make in a retirement portfolio in the first year. So exactly when you retire, what is the rate of withdrawal that you do? Subsequent to the first year, the withdrawal rate is increased by the inflation rate. And because the safe withdrawal rate is calculated based on historical market data, it takes into consideration sequence of return risk and it takes into consideration volatility. So the way to calculate the safe withdrawal rate is not to assume a constant equity return or a debt return, but actually to use actual market data and simulation to arrive at a very robust withdrawal rate which accounts for volatility. Now, when we started thinking about this problem back in pre-COVID days, we realized that there was actually no computation for what the safe withdrawal rate should be for India. So this was calculated in the US by William Bengen in 1994. It was calculated as 4%. And then this number just got imported into different geographies without checking whether that same 4% withdrawal rate is applicable in other geographies or not. Now, when we started to think about this problem, okay, how do we calculate this rate for India? We found it extremely challenging because unlike the US financial market, we don't have much historical data in India. We have very limited data. When Bengen calculated the safe withdrawal rate in the US, he used 100 years of data. When a planner wants to do this in India, we can at best get 40 to 50 years of data. The other problem is this data, even this 40 to 50 years of data shows a declining trend. So if you look at asset returns in India, it's been consistently falling, right? So this is the average monthly Sensex return and the average monthly debt return. It shows a continuous fall. So nominal returns are falling. That's also because nominal inflation has fallen, which makes it very challenging because if you use historical data to calculate safe withdrawal rates, you will overestimate it that investors will get, in future. So we broke the data into high return and low return. We identified, a structural break in the data in the year 2000. We looked at decadal returns and we saw that the post 2000 return data for both equity and debt is probably more representative of what an investor might earn in the future. So we used that data and we computed, we used various statistical techniques, including simulation, and we arrived at the safe withdrawal rate. 35% of the times, the safe withdrawal rate is below 4%. So if you are using the internationally accepted 4% safe withdrawal rate, 35% of the times you will actually run out of your retirement corpus, which is a very, very high risk to take. We prefer a safe withdrawal rate of 3%. In fact, if you want to be ultra conservative, it has to go down all the way to 2.6, but I think that's being too conservative. living with a risk of 8% is good enough, and a 3% withdrawal rate seemed, appropriate. The detailed, study is there. It's publicly available, computing the safe withdrawal rate for a retirement portfolio in India. The first time, we got this study out, there was complete disbelief and denial, and, people were like, how can withdrawal rates be so low? And how, is a retiree expected to retire and live a comfortable life if withdrawal rates are so low? So we did a second study in 2024. I was fortunate to find my co-author Rajan Raju, who does some excellent research in the Indian financial market. You should check out his SSRN webpage, where he hosts all of his research publicly. So both Rajan and I relooked at this issue. We improved on the methodology. In the earlier study, we were simulating equity returns, but I was holding the fixed debt returns constant, inflation constant, and I completely ignored gold. In this study, we simulated everything. We simulated equity returns, we simulated debt returns, we simulated gold returns, and we even simulated the inflation. So we looked at historically what has the numbers been for all of these indicators, and we did more than 1 million simulations across different ratios that you may keep in your portfolio in terms of debt and equity. Broadly, the study confirms that the safe withdrawal rate we are looking at is about 3, to 3.5%. Whether we like it or not, that's, the reality. So to conclude and to hand over to Neil, the problem of generating a pension-like income is a very, very complex problem. I think it's time that we looked at this problem in a much more nuanced manner, and we try and devise better research, more research in terms of how to compute what is a reasonable retirement corpus to have and how much you can withdraw. This is challenging because our financial markets are young. We have limited data. So we have to depend on simulations and historical data. But that's fine. Rather than grouping in the dark, something is better than nothing. In our estimate, the low real returns on debt investments and the volatility, I mean, our asset classes are volatile, and that's a reflection of our financial markets being younger, than other financial markets. So both the volatility and the low real returns on debt investments, they lead to what, somebody may think of as a low safe withdrawal rate, in India. So this is, food for thought for all of you as we think about retirement. Over to you, Neil.
So I think a lot of people are asking for the presentation and those
Kind of.
links in the chat box. I think we can send it to Rajalakshmi ma'am and she can email it.
Yes. It's in the chat box. So just to give you guys an idea of how much mess real life creates. So if you just think of the taxation of capital gains, in just the past 6 years, we have in 2018, we have the long-term capital gains on equity going from 0 to 10%. From 2004 to 18, there was no long-term capital. It was totally zero. Then we have 2023 debt funds, the long-term capital gains become slab rate. Then if you have 2024, the grandfathering of debt funds gets taken away and the long-term capital gains goes further up from 10 to 12.5. So if you made a elaborate plan based on a particular tax rate, within 6 years, the entire tax system seems to have changed. The rates of return also changed. So again, in the 1990s, early 2000s, the rates of returns were 15-18%. You could have safely gotten that. But as the economy has matured, you can't assume that anymore. So now the standard assumption for most financial planners is 12% and conservatively even 10% for equity. So take that into account. And finally, I'm going to keep it really short because let's maximize time for questions. Final thing I want to say is please go to the right places for advice on FIRE, on retirement. So go to somebody like Ravi, who's a SEBI registered investment advisor and who's published a paper on this, because this is complex stuff, it's complex math. If somebody on YouTube comes and tells you that you just need 20x your current income and you're all set to go, that's not the case. That's not reality. So I'll just stop there. Please do check out the 2 links I've posted in the chat and I'll hand over to Aditya. Aditya, you're on mute, I think.
Yeah. So I'm just sharing my PPT, and before I open up, just want to thank Arun Bhai, Ravi Bhai, and Neil Bhau, for the base that they have set. So what I'm going to talk about, before I get to my section, we are today talking about FIRE, which basically stands for financial independence and retirement early, right? So I have a different full form for it. I always say that FIRE stands for, for financial independence. Think about retirement and equities. So, retirement planning is something that has to be thought of from day one, not when you are actually nearing the retirement, right? Because if you plan your retirement when you are nearing that retirement goal, then you're already too late, right? So with that, let me just start my end of the presentation. 1 second. So I hope my presentation is visible, guys.
Yes, it is visible.
So, just some backdrop, Indians inherently, we have always loved gold. We have always loved real estate. We have always loved to keep that money at our homes, below our mattresses, or in fixed deposits, right? So this survey by PGI Mutual Fund in March 2024 sheds light on the same. If you look at the kind of investments people were doing in 2020, majority of it was in, say, fixed deposits or insurance policies. But the position has changed, especially after COVID, and when people have seen the markets going only up, right? So from 71% or from 50% of respondents preferring FD, it has gone down to 40%. And I'll just keep this image open for like 20 seconds so that you can see how the Indian behavior is changing, right? The other thing that Neil Bhau had just alluded to earlier was that you should take your advice from someone who actually does this for a living, right? And not someone who does this for just a commission. So as you can see here, the majority of the retirement planning has been done by talking to, say, insurance agents or bank relationship managers, right? So again, it is a strong recommendation from my side that you actually talk to someone who does retirement planning for a living, who does not just track, say, equity markets or bond markets, but the whole market, right? Because retirement planning is something that involves multiple facets of the financial markets. And not just that, you have to take care of taxation, you need to take care of estate planning. And, this is, retirement planning may be done on Excel, but, this actually involves human lives and human emotions, right? So you have to take all of that into account as well. Now, I was asked to speak about why equities should be a part of a retirement planning, right? And I believe that this image by Funds India does all the talking. Now, if I compare Indian equities versus your gold versus real estate or versus a bond fund or a FD, the answer is very clear. Over the past 20 years, Indian equities have given you a CAGR of 16%, as simple as that. If I talk about gold, it has given you a CAGR of 12.5%. But again, gold is quite complicated because you have to pay a certain storage cost for your gold. And I'm sure a lot of our parents who bought gold were very shocked to see when they went out to sell that gold that it was either impure or it was not 22 karat gold to start itself with, right? So gold has a lot of problems, and I'm talking about physical gold. Of course, if you're getting into a SGB or a gold ETF, then it's a completely different episode. Again, when I talk about real estate, the transaction costs are very high. Real estate is very illiquid. Not everybody can actually afford real estate because it has a high ticket size. And we have heard about a lot of instances where people, they bought a property at 50 lakhs 10 years back, and the property is still at 50 lakhs after 10 years, right? And of course, when I talk about fixed deposits, the rate of interest or the CAGR over the last 15, 20 years has been less than the inflation rate. So, whenever we talk about investment and whenever we talk about retirement corpus, right, you have to ensure that whenever you are planning to create that retirement corpus, right, you make sure that, you're trying to grow it at a rate which is higher than inflation. So when you compare inflation with some of the instruments listed over here, right, so then there are three clear winners. Number one is, of course, Indian equities. Number two is US equities, which can be a bit difficult to understand, and there can be a lot of paperwork involved. And number three is, of course, gold. So what I have done over here is that I have put in a simple case study. And before I start, just wanted to let you know that your retirement corpus journey can be made up of two products, right? Number one can be equity shares, which give you a CAGR of say 14%. Number two can be a debt option where you put in your money in a debt fund or a FD or a recurring deposit, right? But again, the interest that you will get on equity would be almost double than the one that you get on debt. So, so I have taken a simple case study here. Assume that there's a person called A who has started working at the age of 20, right? And he has decided that he'll work till the age of 60. So what this person does basically is that, assuming that he starts with a salary of say some 30,000 or 35,000 or say 20,000. What this person does is that, he starts investing 15,000 every month in a SIP, which is a systematic investment plan. Now, I completely agree with Ravi Bhai over here that, instead of taking a 14 or a 15 or a 16% rate of return every year, we'll take the worst case return. So I have taken a 10% per annum kind of a return on equities. And as Ravi Bhai has already demonstrated, equities has done much more than that. So at 10% per annum, you will get a retirement corpus of almost 34 crores. Now, what happens is that assuming that your yearly expenses today are 12 lakh rupees a year or 1 lakh rupees per month, right? Even if I assume a 7% inflation rate, the inflation will double every 10 years. So this 12 lakhs expense will become 24 lakhs in 10 years. Then it will become again 48 lakhs in the next 10 years. So assuming that, this 12 lakh ka kharcha becomes 50 lakhs by the time you retire, right? Now, at the age of 60, what you can do is that every year you can comfortably withdraw this 1.5%. You can even withdraw 2%. You can even withdraw 3%. And you can comfortably retire. Now, it's very simple, right? How do you actually calculate this retirement corpus? Now, what Ravi Bhai had alluded to that, in the US, 4% withdrawal rate is the norm, right? If you have a very big retirement corpus, you can be even comfortable with 1 or 2%. If you have a small retirement corpus, then maybe you would have to go to say 4, 5, 6%. The basic formula in this is that the yearly growth or the rate of withdrawal should be lesser than the yearly growth rate. So assuming that you create a corpus of say 10 crores by the age of 60, and you want to withdraw say 5 lakhs every year, which is 5%. And the growth rate itself in a portfolio is 8%, which means that you have a 3% margin of safety. Your portfolio will become an annuity and you can comfortably withdraw 5% every year. Now, how do you actually select a portfolio, right? I'm sure that in the last 2-3 years, people also, when they are creating a personal portfolio for themselves, right, or they're creating a portfolio of stocks, what they tend to get swayed towards is the hot sectors. So in the last 1.5, 2 years, defense has been the darling of markets. Railway stocks have been the darling of markets. Manufacturing has been the darling of markets. You would have seen a lot of mutual funds launch manufacturing funds, railway funds, defense funds, right? But when it comes to proper diversification and proper retirement planning, make sure that your portfolio is diversified. So this is a very brilliant diagram, and I think this was shared by Mr. Neil on Twitter. Every sector will have its own time. So financial services, they did very well in the year 2014. Again, auto did very well in the year 2014. Auto did very bad in the year 2018 and 2019. Again, this year auto has done very well. In fact, it is one of the best performing sectors. PSU theme did very bad at the 5, 6, 7 years of the start of this decade. But in the last 2, 3 years, everybody's running after PSUs. So my point being that, whenever you create a portfolio, make sure that you have a diversified portfolio of either equity mutual funds or you have a diversified portfolio of equity stocks. Your purpose can be either retirement or it can be retirement linked to another goal. It can be buying a house. It can be trying to withdraw an amount for your children's education or a grandchildren's education. It can be a child's marriage, right? So, whenever you are talking about retirement planning, right, it is extremely important to define your goals. When you actually define those goals, it becomes like a Google map for you. When you define those goals, when you define that amount, and you also define the time period, right, it becomes kind of a Google map for you, because then you can back calculate the kind of returns you want. Now, assuming that I am today at 1 crore and, I'm nearing my retirement in the next 10 years, right? And I feel that 2 crores is a very good amount for me. Now I know that to reach 2 crores from 1 crores in the next 10 years, I can be comfortable with a rate of return of 7%, right? So then I can put it in blue chips. I can do blue chips plus FD plus some debt instruments, right? But assuming that today I'm at 1 crore and I want to be 3 crores in the next 10 years, then my rate of return becomes almost 15-17%. So in this case, I have to take a little bit more amount of risk. I have to maybe go towards blue chips and mid caps both, and I can't have any debt in my portfolio because the rate of return that I require is upwards of 15% CAGR. So the moment you define your goals, you define your starting point, you define your end point, you find out the rate of return that you require from the markets. It becomes very easy for you to calculate the kind of instruments that you can get into. So this is again a prelude to the previous slide. How should you actually select stocks? So the previous slide was on how to select equity mutual funds. This one is more about how to select stocks. So it's very simple. The cost of capital or the cost of doing business in India itself is close to 10%. So whenever you are selecting a stock, make sure that the return or the growth percentage of the company every year is higher than that. Number one. Number two, like Mr. Neil was saying that don't try to take your advice from a YouTube channel. Make sure that you do your own due diligence. This is your hard-earned money after all. Every sector has its ear, so make sure that you diversify. This is like whenever I explain diversification to first-time investors, right? I always tell them that this is like a lunch thali. In your lunch thali, you don't just eat pickle or you don't just eat dal. You have roti, sabji, pickle, dessert, rice. So all your financial instruments or all your equity mutual funds or all your equity stocks are like that. You have to have a balanced meal or you need to have a balanced portfolio, right? So like I said, earlier, depending on the kind of risk appetite that you have or depending on the kind of returns that you expect, you can either get into value stocks or you can either get into growth stocks. And again, there is no right or wrong answer over here for a retirement because over the long term, like I have shown the diagram over here on the bottom right hand side, the growth and the value index almost coincide in value. So there are some years when value will do very well, such as a high interest rate. Whenever there are high interest rates in the economy, value will do well. Whenever there are low interest rates in the economy, growth will do very well. But they will keep going up and down. Again, on the bottom left hand side, you can see the diagram in the US where growth has outperformed and then value has also outperformed. So conclusion, risk returns will actually define risk and returns will define the kind of product that you want to get into. Whenever you are investing or whenever you're talking about a retirement corpus, make sure that you start from day one. The moment you get your salary, start retirement planning. Of course, as you age, as you mature in life, as your responsibilities change, the kind of obligations or the kind of responsibilities you have will also change. Like Arun Bhai was saying, every year the market corrects 10-15%, and every 7 to 10 years the market will correct almost 50-60%, right? So make sure that you create this portfolio in such a way that you're able to digest those volatility. Make sure that you try to monetize on them, and don't just buy and forget whatever you're buying. Buy and track. Because like Neil Bhai was saying, there are a lot of fund changes that have happened in the last 3-4 years. So yeah, I mean, this is a slide that I always show in all my presentations. If I talk about the events that have actually shaken the financial markets across the globe, including India, of course, there must have been minimum of 50-60 events which actually said that the world is about to end, but the world hasn't ended, right? So keep the faith, keep investing, and stay put for the long term.
Thank you, Aditya sir. So there are many queries that had been put up on the question and answer session. So maybe I can take a few of them for you. So one, Mr. Pavan Kumaran, he has a query. Can we stay invested in index fund continuously for 10-15 years, irrespective of how market performs, or do we need to have proper exit and entry strategy for such long period of investing? Any one of you would like to answer this one?
Ma'am, could you repeat the question? Sorry, I missed it.
Yeah. Can we stay invested in index funds continuously for 10 to 15 years, irrespective of how the market performance? or do we need to have proper exit and entry strategy for such long-term investing?
I can take it up, guys, if you want.
Yeah,
So,
please go ahead.
so see, index funds, the reason why people choose index funds over active funds is the reason that, they want to put all of their investments on autopilot. I mean, some people are so busy that they don't get the time to track the markets or, to track a sector or to track a fund manager. So definitely, I don't think that you need to have a exit point in mind in index funds unless and until you're planning to withdraw it for your retirement. Uh, and the second exception to index funds would be that, you have gotten into an index fund because the sector is going to do well. For example, the Nifty Auto Index, maybe you would have gotten into it 3 years back, and then maybe you would have to do an exit because the auto sector is a cyclical industry, right? So it will have its peaks and it will have its troughs. So index fund like a Nifty 50, it is a broad-based index fund, right? It will have companies from all the sectors. So you can hold that index until eternity or until retirement, but an index which is cyclical like a Nifty Auto Index or a Nifty FMCG Index or a Nifty Pharma Index, wherein you have gotten into it because you want to play a tactical cycle, in that kind of an index fund, definitely would have to find an exit and then reallocate that.
All right. Okay, so there is a repetitive question which has come from many people. So the question is, which is better, investing in mutual funds or investing in equity? If some comparative judgment can be shared.
Could I take that one? So I am personally a very strong believer in mutual funds, and I have no axe to grind. As in, I have, I'm indifferent as an investor, as a journalist between both. The reason why I like mutual funds is that there are professionals who manage your money there. People who do direct stocks, they think they've done very well in a bull market. In a bull market, you buy anything that goes up and you think you're a genius. But the reality is that more often than not, you don't have the time or the expertise to actually run a portfolio, to actually research a portfolio. The second is tax advantage. So if you directly buy and sell stocks, then you are subject to capital gains tax, which has gone up incidentally in this budget every time you book your profits. Whereas if the fund manager does it inside the mutual fund, then so long as you don't redeem your fund, you don't have to pay any tax. So that works as a tremendous compounding machine. And the third is dividends. So again, direct stocks, when you get dividends, you're taxed at your slab rate. When the same dividends come into the fund, they increase the fund NAV, and you are not taxed until you redeem your units. And that too, when you redeem, you will be subject to long-term capital gains tax at 12.5 and not taxed at slab rate. So there are a lot of benefits. Expense ratios have gone down massively. You get professional management and tax efficiency. So mutual funds definitely have a huge advantage.
Thank you, Neil, sir. One more query. What is the hedge strategy if you accidentally outlive your retirement tenure?
So maybe I can take that. So generally, when we do retirement planning, even if we use sophisticated methodologies, you have to create redundancy in the financial plan. So one way to create redundancy is to leave immovable properties completely out of computation, right? Which works both ways. Generally, people don't monetize their immovable properties. So it's actually good to remove those investments from your retirement corpus. Second is that if push comes to shove, right? Even though the reverse, mortgage market is not developed in India, but if you accidentally run short of your retirement corpus, you can look at liquidating your removable properties and moving into a rented, accommodation. So I think it's just about creating redundancies. Second is whatever analysis that we had done and I had shown, those are static withdrawal strategies. So because static withdrawal strategies are generically applicable to everyone. So you can have a static withdrawal strategy. You can fix a safe withdrawal rate and then withdraw continuously based on that static withdrawal. But if based on annual reviews or periodic reviews, it appears that the retirement corpus actual value is deviating, from the expected value, you have to shift into a dynamic withdrawal strategy, where you can lower your withdrawals for a certain number of quarters or a certain number of years and play catch up, and then maybe withdraw more subsequently when the retirement portfolio regains its value. So there are different strategies that planners use to try and make sure that you don't run out of your retirement corpus. I also wanted to make clear one thing, that retirement planning is a continuous activity. So just because you have made a plan at 60 or 55 and you have done some projection doesn't mean that those projections need not get updated in the future. It's a good idea to get those projections reviewed every year so that you don't land up in a situation where course correction becomes a big problem.
Thank you, Ravi sir. One more question. Is there any thumb rule for equity exposure with our retirement corpus? Mr. Jain Pillai is asking this question. He's asking, say I have 1 crore corpus towards my retirement time.
Sure. So uh, in case anybody wants to add, or should I take this? Okay. So we did research on different asset allocation strategies between debt and equity, because I think a common feedback that we get from clients and from people who read our research is that let's look at a higher withdrawal rate by increasing the share of equity in the portfolio. Unfortunately, that doesn't work. So our comfort range is to use 50 to 60% debt investment in a retirement portfolio, balance in equity. Uh, if you want to reduce the debt component, then rather than introducing equity, we actually look to introduce gold. So you may have 10 to 15% allocation to gold, 45 to 50 odd percent in debt, and balance in equity. The reason why you cannot use a lot of equity in a retirement portfolio is because compounding cycle gets broken in a retirement corpus due to continuous withdrawals. So equity works really well in a portfolio where you don't disturb that portfolio, you're not touching that portfolio at all. But in a retirement portfolio, which will see continuous withdrawals, you have to be very careful in terms of how much equity you use. So in fact, based on actual data, our research shows that if you increase the share of equity beyond 40 to 50% in a retirement portfolio, you actually get inferior results simply because the volatility in that portfolio becomes so high that the longevity of that retirement corpus actually falls, which actually leads to even a lower withdrawal rate than what you would anticipate, by increasing the share of equity. So long story short, stick to the typical 60-40 portfolio, 60 debt, 40 equity. And if you find that to be very conservative, then instead of 60 in debt, you can remove 10 to 15% allocation from that and have it in gold. But equity should ideally not exceed 40% exposure.
Thank you, Ravi
Yeah,
sir.
I just
Since
Ravi.
we are running out of time, so maybe we can
Yeah,
take
I
one
think
last.
Arun, I think has just a point to make.
Yeah. I just had a question on this. Just curious. Ravi, when you calculate the withdrawal rates, right? Say for the same portfolio at say 60% debt and 40% equity. So let's say next year equity for some reason has a large fall. Say it's COVID and it's already down by 40%. So when you calculate the withdrawal, it is from both debt and equity, or is it only from debt because equities have how do you calculate this? Just curious on this.
Yeah. So in the research, we have done an proportionate withdrawal from equity, debt, and gold. You can actually use bucketing strategy as well. So what you can do is you can have an allocation to equity, not touch it, and then withdraw from debt or gold. Incrementally, it doesn't make much of a difference.
Right.
Bucketing strategy is more intuitively easier to understand, more easier to implement as well. But the broad math in terms of how much people can use in the retirement corpus, that math broadly remains the same.
Right. So it would be 60% from debt and 40% from equities, which is, so let's say I'm withdrawing 100 rupees, it will be 60 rupees from debt and 40 rupees from equity. independent of how the market is moving.
Yes, yes.
Okay, got it.
And
Sure,
and
thanks.
it factors in tax rate of when we did our research, long-term capital gain was 10% on equity, and for debt we have assumed the full 30% tax.
Got it. Sure, thanks.
Okay, so since we are already running out of time, probably we can take one last question. So there is this one question. What is the future of US market and US technology companies in the next 15 years? Should we invest in them or should we just be sticking to the Indian market?
So yeah, probably I can take this. See, broadly, the idea is that it's very hard to predict precise sectors. So what I would suggest is that uh, broadly, if you're looking at global investing as a diversification strategy, US markets make a lot more sense because fundamentally it's a capitalist economy. Let's say if you're playing a Chinese equity or some other equity market, then even there are reasons for, I mean, even if let's say China markets are very cheap and all that, it's still not a capitalistic economy, which means that the government's intervention might be, I mean, it's very hard to predict because there are hundreds of other moving parts. So broadly, I think the starting point is that India is a great country where we have seen capitalism work pretty well, and US is already a proven. So especially when as investors, when you are investing money, the whole idea is that few entrepreneurs who are able to take higher risk get disproportionately awarded. Right now, fundamentally, if you start assuming that, hey, I don't like capitalism, and why is this one particular person getting rich, then it is a problem. So I think from that standpoint, if you're looking at global diversification, US becomes a good starting point. So I think it's good to start with 20% at least to US, and then the second question comes that within US, should you go tech or should you go? And even if you buy a broad S&P 500 index, it will naturally have a lot of tech. Now again, it depends on can Amazon be classified as a tech company? Because net I am just buying whatever I require, right? Like let's say I want a pen, I want a book. So essentially, do you call it a retail grocery store or do you classify it as tech? So my sense is, while tech is a fancy word and you use it to refer to AI, but mostly the index which represents tech, like say Nasdaq 100, most of the companies, if you see, they are products which we kind of use on a day-to-day basis and which has very low representation from an Indian standpoint. So overall, I believe that US markets can be looked at as a structural story, just like how we are looking at India. And my sense is it's good to have one portion towards US. So the worst case, if something goes wrong in India, you are having a very good diversification through US. And within that, I personally like tech, but again, tech not in a puristic sense. But if you look at say Amazons or the Facebooks of the world, and anyway you play it through either Nasdaq or the S&P 500. So whether you like it or not, this tech will be a very large proportion. And again, tech is not a large part of the Indian in a puristic way. We have this Infosys of the world, but the tech that US represents is a futuristic thing. So I think it makes a lot of sense to at least have 20%, and then over a period of time, as your portfolios become large, you can look at probably 30%.
Thank you, Arun sir. We have finally come to an end of this impactful session, even though we want this session to continue for a longer time. But still, probably we can have such sessions in the future also, for sure. So, on behalf of NISM, I would like to extend my heartfelt gratitude to all our distinguished speakers, to Arun sir, Ravi sir, Neil sir, and Aditya sir. Actually, your willingness to take up time out of your busy schedule to share all these invaluable insight with us is deeply appreciated. Your expertise today will definitely inspire so many to take sound financial decisions. A special thanks to all the participants for your active engagement and thoughtful questions. Your enthusiasm and curiosity has greatly enriched our discussion and played a pivotal role in the success of this webinar. So, thank you all for making this event truly memorable and impactful. And have a very good evening to all of you.
Thank you all.
Yeah, thank you so much.
Thank you.
Thanks everyone.
Thank you very much.
Bye-bye.